In the final interest rate announcement from the Bank of Canada this year, Governor Tiff Macklem delivered news economists expected to hear. The key rate was brought down by 50 basis points, with Macklem citing a number of factors. Unemployment rate is on the rise in Canada following a shift in federal immigration policies. New GDP numbers were weaker than expected, and President-elect Trump might be bringing in some hefty tariffs on Canadian exports when he's back in the White House. Tessa Bennett joins us now to break down the numbers. Tessa, where does the interest rate stand?
Manisa, the central bank's new key rate is 3.25% after one of the most aggressive cuts this year. And Tiff Macklem says the move is being made as the Bank of Canada nears its 2% inflation target.
With inflation back to target, we've cut the policy rate by 50 basis points at each of the last two decisions, because monetary policy no longer needs to be clearly in restrictive territory.
Keeping consistent with a steady pattern of cuts, the Bank of Canada has lowered its key interest rate for the fifth consecutive time this year. This move brings the central bank's rate down by half a percentage point to 3.25%. Over the span of roughly 6 months, the BOC has lowered borrowing costs by 175 basis points total, becoming an aggressive rate cutter among the major economies' central banks. Bank of Canada Governor Tiff Macklem says consumer spending and housing activity in the country both picked up as a direct result of lower interest rates. And economists were predicting another weighty cut this time, citing the latest GDP report indicating growth came in below the bank's projection and a significant jump in the country's unemployment rate.
Given that we had that very disappointing unemployment report on Friday, and we've had a string of relatively negative growth reports in recent months. So, the Canadian economy is clearly underperforming and needs a more accommodative monetary policy stance from the Bank of Canada.
Last week's job report also had somewhat of a dampening effect on the loonie, continuing a downward trend, losing roughly half a cent on the American dollar. Shimada says this rate cut, in combination with poor oil prices and a weaker domestic economy, is driving the value even lower.
You take all of those things in combination, and they're putting, downward pressure on a currency that wasn't in great shape to begin with, and is getting worse with every announcement that comes out.
And with all of that is the threat of hefty tariffs on Canadian exports attached to the incoming Trump administration. Macklem says this was a big factor in deciding just how much to lower the rate.
This is a major new uncertainty.
This considerable cut comes as the Trudeau government is days away from introducing its GST holiday, suspending tax on certain products until mid-February.
Monetary policy is trying to do its thing in bringing down kind of inflation, but then the fiscal side, it's kind of been a very expensive few years for the government with the pandemic, and then the recent announcements in the federal level about this GST holiday, that kind of surprised everybody. Monetary policy can do its best, but let's say they cut rates, but then the federal government decides to do its own thing, then inflation will respond there.
With the consistent lowering of the Bank of Canada's key rate over the last few months, Canadian consumers might be wondering how much of an impact this will have on their household spending. And Boutros says some might notice the drop right away.
If you have a variable rate mortgage, then you will immediately feel the impact of the rate cut because your interest rate went down. If you have a fixed rate mortgage, you're not going to feel those impacts.
Despite the significant interest rate drops the Bank of Canada has been announcing over the past few months, Macklem said today the pace of these cuts will likely slow down next year.